Hi, and welcome to another episode of Investing for Beginners. Today, we're going to be talking about investment theses. This presentation is brought to you by ElderWatch. We are a 20-plus year collaboration between AARP and the Colorado Attorney General's Office. Our goal is to educate and protect older Coloradans in the realms of fraud and financial literacy. So if you or someone you know has experienced an investment scam, or maybe following this presentation, you want some more information on how to invest safely, go ahead and give us a phone call. Our phone number is 800-222-4444, select option 2. My name is Jessica Zwodzki, and I am the program specialist for ElderWatch Colorado. So today's topic is investment theses. In a nutshell, your investment thesis is the reason that you are investing in a particular stock or security. In less simple terms, the term investment thesis refers to a reasoned argument for a particular investment strategy, and it's backed up by research and analysis. Investment theses may be prepared by professionals, and they may be prepared for businesses and individual investors. When they are prepared by professionals, it's usually a more formal written document. But this is investing for beginners. So today, we're going to talk about some of the things that you want to consider when you are thinking about investing in a particular stock or security. Now, before we keep going, important reminder, disclaimer, ElderWatch does not provide financial or legal advice. You can definitely get exposed to the market all by yourself. However, you can also consult with a professional if this sounds a little scary to you and you're still not certain. One of the things that informs your investment thesis might be industry. So let's look at an example to really illustrate what I'm trying to say. So let's say that 5 or 6 years ago, you first heard about ChatGPT. It wasn't really a thing yet the way it is today, but you had a hunch that generative AI was really going to revolutionize the way that we live, work, and play. So as a result, if you were making this guess about how the industry was going to unfold, that informs your investment thesis. Another thing that might inform your investment thesis is the political climate. So let's say you're watching the news, and this is a hypothetical, but let's say you're watching the news and you see that a new bill has passed and that this bill is going to reduce the cost for producing renewable energy in the United States. So let's say that you then decide to invest in a wind farm because you think that this bill and the decrease in production costs will lead to not only a growth in the number of wind farms, but an uptick in the utilization of energy that comes from wind farms. In this case, your investment thesis would be around the hypothesis that this bill and the political climate for renewable energy would lead to growth and sustainability within the sector, and as a result, lead to gains for you. I think that the best way to explain related industries is to use an example. So let's go to our wind farm example. So in that example, a bill has passed, and as a result, you think that there's going to be more wind farms, and you think that the energy that we're using, a bigger percentage of it is going to come from wind farms. So instead of investing directly into a wind farm, you might choose to invest in, for example, steel or fiberglass, which help to create the turbines. You might also choose to invest in a startup that has a technology that prevents birds from hitting those turbines. So in this case, you're not necessarily investing in the wind farm itself, but you are investing in the tangential industries, the tangential companies, securities, etc., that will also be impacted by the wind farm. In the examples I've given so far, they might sound a little risky. They're really built around hypotheticals, your predictions on what's going to happen, and there can always be unexpected events that occur, even though on average the market yields about a 7% annual return. So if you're looking to get into investing, but you don't really want to play this guessing game, One thing that you might want to do is to invest with the thesis of stability. Now, this is also kind of an investment strategy, so we're going to get into it in another video, but one way that you might use stability as the core of your investment thesis is to invest in blue chip stocks. And this name comes from poker. We're not going to get into the etymology, but essentially, blue chip stocks are companies that have been around generally for a long time. They tend to be a leader in their industry. They're often a household name, and they have a demonstrated ability of being able to weather market volatility. So some examples of blue chip stocks are Microsoft, Walmart, McDonald's, Johnson & Johnson. So if you choose to invest in blue chip stocks, the investment thesis is that they are going to continue to weather the course. They are going to continue to maintain that track record. They will continue being a household name, and you think that that industry will stay stable. And so there's your investment thesis for stability. If you're nervous about building your own investment thesis, more than fair. Maybe you weren't expecting to have to think on this macro level about how you think the market in certain industries are going to go. And that's okay. You can still participate in the market. I have two ideas that can help make it a little bit easier. And the first one is to start small. You do not have to, on many platforms, buy a whole share of something. You can buy fractional shares. So let's say you want to invest in Jessica Zawatsky Enterprises, and one share of my company is trading at $125. Instead of buying one share, you could buy a tenth of a share for $12.50. And that way you are still exposed to my stock, you are still experiencing that growth, but you've only sunk in 10% of the cost of an individual share. So starting small can definitely be great when you are first starting out in the market. My other idea is to invest in a fund. And there's a couple different kinds of funds, but I'm going to explain a fund with a metaphor because I love metaphors. So let's say that you are going to go on a picnic and you want to invest in the picnic. So you could individually invest in forks, in a blanket, in cheese, in grapes, in turkey, or you could invest in a fund. So instead of making 5 individual investments, a fund is one investment. So instead of paying for each of those singular things, you are paying one fee to be exposed to all of the things within that picnic basket. And this is a way that you can also shield yourself from market volatility. Because let's say that, I don't know, for example, the value of the stock of silverware goes way up, and then the value of a stock of cheese goes way down. It's kind of going to even out. And so it will reduce that volatility. It will reduce that risk. So if you're nervous about building an investment thesis, start small, consider investing in a fund. Regardless of the investment thesis that you employ for a particular stock or security, or even if you invest in a fund, it's important to be aware of the bandwagon effect. And this is the idea of doing something just because everybody else is doing it, and it can be a very powerful draw, particularly in the market. An investment thesis built on the bandwagon effect is a bad idea for the same reason your parents might have said, if your friends jumped off a cliff, would you? Be careful if you find yourself investing in something just because everyone else is, because things might not pan out in your favor and there might be ulterior motives sometimes, and we won't talk about it in this series, but sometimes people are trying to drive up the price of a stock so that they can buy low and sell high. Lots of different reasons that you might not be aware of. And so having a sound investment thesis is a great way to shield yourself from some of these market manipulations, as well as the unintended consequences that might not be quite as obvious. Investing can be an excellent way to help your money make some more money, but it comes with inherent risk. Even though on average there is a 7% annual yield, it's not guaranteed, and some securities might do better than others. So it's very important to understand some of these foundational concepts before you dive into the market. If this is the first video you're seeing in the series, we have also covered investment fraud and scams, and then we'll be doing a two-part arc on investment strategies. But for all of us here at ElderWatch, thank you for joining. I hope that this video helps your money make a little bit more sense, and I'll see you next time. Bye.